Starbucks is hosting its Investor Day right here in New York City, and I'm joined right now on CNBC by Starbucks CFO, Cathy Smith. Cathy, great to see you. Thanks for joining us.
Thank you for having me. Thanks for being here today.
Of course. So the company announced today its long-awaited long-term financial guidance looking out toward 2028. Tell us why you felt now was the time in the turnaround plan to release those numbers.
We set the Back to Starbucks plan, a year ago, and it's clear now we're seeing the momentum and the plan is working, and more importantly, I think we see what's going to be necessary for the turnaround, and we actually know what it takes to get us there. So we felt like this was the right time. We can see pretty good line of sight for the next 3 years, assuming that the world doesn't fall apart or something, but we see pretty good line of sight for the next 3 years. So we thought today was a good point to talk about that milestone. That's not the destination in 3 years out, but it's a good milestone to aim towards.
And yesterday during earnings for the first quarter, you also gave a 2026 outlook.
Yeah.
Can you talk a bit about how both tariffs and coffee volatility factored into the two outlooks that you gave investors?
Yeah, so coffee and tariffs caused us a little bit of pressure early on in this year, and then obviously late last year. We see those abating, so the great news is coffee prices should be coming down. We typically buy a little bit into inventory, so we'll see it roll through for the next couple of quarters. But our coffee prices in the coffee houses to our customers are at a great value. Don't anticipate any pressure on that with coffee prices coming down. And then tariffs have kind of moderated. I think they're at a good place. We feel really good with the guidance we gave, obviously, and the impact's pretty minimal in the back half of the year.
And part of the guidance you gave today was that 3% global comp in 2028. Is that a new baseline for the brand, and what upside do you see given some of the catalysts that were announced at Investor Day today?
First off, 3% comp is a really good comp for our size, scale, and our global nature. I think that's really great. It's underpinned by transactions. We saw this last quarter a 4% comp, 3% transactions. That means more customers are choosing us more often, and so we think that's a really great place to be. We've got so many demand drivers. I think you heard them here today. Everything from that amazing green apron service for your customer experience. We have the menu innovation that Tracy talked about, and how we're going to have that always on, great brand marketing that you continue to see. So we've just got so much in the pipeline to underpin the transaction growth, which will then yield that 3% comp. Feel like we can continually do that. We said 3% plus. We think that there's a plus to it, but it would be a really good outcome, I think, for our customers and our shareholders at a 3 comp.
Another focal point for Wall Street, of course, has been margin growth, and you talked today about injecting disciplined pricing to get to that range of 13.5% to 15%. What does disciplined pricing look like, and is there any concern about customers kind of bristling at potentially higher prices?
Yeah, so I'll start with margin growth is first going to come from probably not pricing for us. Pricing is going to be our last lever. Having a great value perception by our customers is really important. Our value scores are kind of back at all-time highs now across all age groups, which is terrific. So we want to use price very selectively, only raise price when we have to. We're going to see a little bit of inflation. We'll want to make sure we price for that. But our margin expansion is really coming from 2 places. That top line growth, so we'll get some great leverage, and then the cost savings agenda that we've got.
I want to turn to the cost savings agenda. So $2 billion in cost savings, big number. Some of that will come from technology and AI. So tell us a little bit about what that might look like in the front of the stores and behind the counter.
The technology investments, first off, we've got a fairly robust technology agenda, which is great. We're going to see the technology start to show up in really small places. You heard about it in our assistant that we have in the coffee houses. We call it Green Dot Assist. I think it was on display here today. And that starts to use a little bit of AI. Brian talked about how it's a great assistant to the barista at the drive-through, that they can it'll start to take the order, not there yet, it'll start to take the order for the barista, so the barista can focus on that connection moment, which is great. So we'll see a little bit of it there, but a lot of our margin expansion or that cost savings, the line of sight we had is actually a lot of not technology enabled stuff. How we want technology to show up is so that we continue to drive those great experiences for our customer, and also to be a productivity measure for the, think about like the support center. So it's a great way for the support center to not grow our costs there, use technology investments to help offset that.
And also too, as you know, Brian and the other executives highlighted today, kind of free up baristas in a lot of senses to interact a little bit more with consumers, right?
Yeah, that's exactly right. So like at the ordering, so that the headset can hear, AI will take the order, actually put it in voice to the machine, and the barista works on that customer experience, and that's probably more important. It is more important as well. The other places we're starting to see it that's a great assistant to the team in the stores, to our partners, is things like our automated counting and stuff like that. We are using technology there. We always want to preserve that customer barista connection. We think that that's paramount. But technology can do the work in the background, and that's a good thing.
I'd like to turn to China and talk about the potential for the joint venture and its impact on EPS. I know it might negatively impact EPS, but then there is growth potential that could offset that. So can you talk a little bit about that? Yeah,
you're exactly right. So first off, we're really optimistic about China long term. We've built an amazing business, 8,000 stores, company-owned stores, in mostly tier 1 and tier 2 cities. When we went to look for a partner, we were looking for one that could help us to accelerate growth beyond that. So it's clear some of the competitors are growing in tier 3, 4, and 5 cities. So we went to a capital partner. We're thrilled with Boyu, which we've announced. We haven't closed the transaction. That'll help us to grow into just grow the business and grow into those other cities. What that does, though, for us as Starbucks, it allows us to continue that growth. The little bit of dilution you mentioned would have assumed a more modest current Starbucks expectation of growth. Our capital partner, I assure you, has bigger growth expectations. So once we layer those on, I think we'll offset that little bit of dilution we were seeing out in 2028.
And then just finally, you're calling this kind of a stop along the journey, right, as you turn the company around. So looking out to 2028 and beyond, where do you see the biggest opportunity to create more value for shareholders at Starbucks?
The first one is always going to be on top line. I just believe that's always the key for success. And so if we keep doing the right things, having a great customer experience, having a great coffee house experience, having that great menu, innovation, and marketing, I think that'll be the first thing. But beyond that, we say it's a waypoint, not the destination. For margin in particular, because that's what the investment community would love and our shareholders would love, is to see us continue to grow our earnings per share. I think a couple of things to point to are longer term things, like we still have work to do in our supply chain. We still have work to do as we build new coffee houses with a better cost profile. Those take a while. Just think all the coffee houses I opened this year, 150 to 175, or in 28, 400 in the US net. I have a base of 10,100 stores. So even with a much better cost profile, it takes a long time for that to start to move the economics or the P&L of the company. So when you get past 28, I can still get margin expansion. It's just going to be from all the work we're doing now. It'll just start to show up where it actually makes a difference in the P&L.
Great.
So we're doing it now.
Well, we look forward to hearing more about it, Kathy. Thank you so much for being here.
Thanks for having me.